And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the show. Of course, it's Tuesday as we get prepared for the big moment. It's the big moment tomorrow, the Fed meeting. We've been waiting for this ever since the last Fed meeting, but it's the next Fed meeting, and the markets are all waiting for this because it's going to be either 25 or 50 basis points, whatever it is. Markets have been rallying ahead of that. In fact, bonds, as we talked a little bit about yesterday, this is the largest front running by bonds of a Fed rate cut in recent history. So, I mean, it's just bonds are just really have been rallying sharply against this idea of a Fed rate cut tomorrow. So we'll see what happens. There's a potential risk building in the markets for a bit of a decline, just under the risk of disappointment. There's about a 60% chance right now, the markets are expecting, with about a 60% chance that the Fed will cut by 50 basis points tomorrow rather than 25. So maybe, one of the things going into tomorrow is that a 25 basis point cut disappoints the market and we get a little bit of a sell-off. We'll see. I don't know, right? This market's just been a little bit nuts lately. But there are a few things that are kind of going on that are driving the markets. But also we've got some things coming up, as we'll talk about in a minute, as we get into the what you need to know before the bell segment, coming up before earnings season, which, by the way, is just right around the corner, and we'll be back into earnings season again. This morning, Microsoft is announcing a 10% increase to its dividend. So again, as these companies are getting more mature, they're starting to become dividend payers, which is a good thing. Companies that tend to pay out a dividend tend to be better stewards of capital over time, and so so this is good, right? So Microsoft's starting to, move into that category, paying out more dividends, and we're seeing that. Apple's paying out a dividend, others, they're starting to move in that direction as these companies get more mature. They're starting to pay out more dividends. Dividends are indeed a return of capital to shareholders, and stock buybacks are not. So let's just keep that reminder out there. Interestingly enough, there was a bit of a misnomer. I'm thinking about writing an article on this, but recently the Harris campaign is talking about raising corporate tax rates to 28%, and it's like, okay, we're going to get corporations to pay their fair share. The problem with that is that corporations don't pay taxes. Corporations are tax collectors for the government. And what I mean by that is that while corporations, you may raise the tax rate on corporation, it is the shareholders that pay the taxes for the company, either through reduced earnings by the company, lower stock prices, etc., or higher cost of products, goods, or services sold or passed through to consumers. So higher taxes are in fact inflationary in a way, because that corporate tax rate increase, that increased cost of businesses gets factored into the products, goods, or services sold and is passed on to the consumer, or if it's not, it then reflects back into lower earnings per share, which is then paid for by shareholders. So it's interesting that we have this idea that we need to tax the rich. We need to get more. As we talked about before, the top 50% of income earners pay all the taxes. 97.3% of all taxes are paid by the top 50% of income earners. So exactly how much is the fair share is the question. See, that's the one question. These rhetorics always sound great during campaigns. So the rich need to pay their fair share. Okay, great, but what is the fair share? Right? If you're trying to solve the deficit or debt problem, you can tax the wealthy 100% of their income, and you won't even put a dent into the debt or the deficit, and then you've got nothing left to tax, right? So these are always the problem with taxation changes. They sound great, but there are ramifications of this on the economy. Higher taxes do get reflected back, and unfortunately, it is the bottom 50% of the population that winds up actually getting hurt the most by higher tax rates. And so there's actually an argument to be made, and this has been made a few times in history, about eliminating corporate taxes altogether just to ease that burden on consumers. Let's talk about what you need to know before the bell, because again, tomorrow is the big day, right? The Fed's going to cut rates. Markets have been rallying very nicely in anticipation of that. Yesterday, we rallied, started off a little bit weak in the morning and then turned around in the afternoon, rallied up into positive territory, finished the day in a positive, back at recent all-time highs. So we have just kind of remained in this consolidation now for a bit of time here, just trading above the 100-day moving average. As we've talked about before, we had a very nice reflexive rally kind of coming off these August lows and have been building kind of a pattern of higher lows at this point. So if the market can break out and form a bit of a higher high here, then we're going to kind of continue this trajectory. And again, tomorrow will be a good indication of what happens next. But importantly, right here, as we were selling off, that was that yen carry trade crisis issue. That's where stock buybacks opened back up. The window for buybacks opened up right at that point. And as soon as that occurred, we had a lot of buying come into the markets by corporations doing their share buybacks. That window now starts to close starting today. So we are now moving into, we're about 2 weeks out now from the beginning of corporate earnings season, which begins in the first week of October. So that window, that buying power kind of for the market is going to start to fade here. So it may be, not today in particular, but over the next couple of weeks, the number of stocks that are going into blackout from buybacks is going to start increasing. And by the time we get to the end of the month, we'll be at about 100, close to fully blacked out for buybacks. So again, this kind of lift that the market got from buybacks is going to start to fade. So again, there's going to be less buying power here. And again, the question, as we've talked about before, is that this rally is very nice here. We're on a buy signal. We're getting overbought, but we could go a little bit higher here. Remember, markets can remain overbought longer than you think. But we are on a buy signal here at a decently high level. So again, we may get some more upside out of the markets here near term, but potentially with some of that buying support coming out of the markets, upside may be somewhat limited. So if you got caught in this downdraft and your portfolio kind of got rocked and you didn't like the way that felt, use this time right here. Don't get overly exuberant here as we start to move into the last half of the year. We are seeing some signs of economic weakness, not necessarily a recession, but could impact earnings. But, if you didn't like that sell-off that we had with the yen carry trade, again, it just tells you you've got too much risk in your portfolio. So use this rally here as a great time to rebalance a little bit. Cyclicals have been really outperforming defensive stocks earlier, but really ever since kind of coming into this summer period, defensive stocks like utilities and real estate have gotten really extremely elevated. We've had very, very strong runs in defensive stocks as of late. So again, that's a good time. We're going to be looking at doing this week, as potentially rebalancing some of that risk in the defensive sectors of our portfolio, which have really gotten very extended here in the short term. And we're seeing hedge funds now starting to rotate back into mega caps anyway, kind of that cyclical defensive rotation. And that's not really surprising. Markets kind of ebb and flow over time. So take a look at your defensive holdings. If they've gotten really extended here, really overbought, just rebalance back to target and maybe look at some of your more cyclical stocks potentially heading into the end of the year. And with rate cuts kind of behind us, maybe start to look to rebalance those positions as well. That's what you need to know before the bell this morning. We'll come back, pick up with John Penn, who's joining me this morning. We're talking a little bit about momentum trading as well when we come back from the break. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
All right, welcome back to the show this morning. First of all, there's quite a few of you hanging out in the watching our video stream this morning. We've only got like 35 likes right now, so hit that like button for us. The more likes we get, the better this show kind of promotes itself. So just hitting that like button for us really helps us out, and we appreciate it very much. That's a little thumbs up guy, by the way, not the thumbs down guy. So anyway, good morning, John. How are you?
Good morning. How are you?
Good. I want to talk about something real quick. I've gotten a lot of emails as of late, and asking about different ETFs that are out there, and one of them is the Momentum ETF, and again, the MTUM is the symbol. And I get a lot of questions like, market's been doing great, so I'm buying this Momentum ETF, and momentum investing is a very good way to manage your portfolio if you're really dedicated to paying attention to momentum. Momentum works on the way up. It doesn't work on the way down. So just kind of keep that in mind. But there's a huge difference between, and so when I was getting these questions, I ran across this article written by Brent a couple of years ago, talking about momentum investing, and he made some really, really good points. And so I wrote an article that's on the website this morning talking about the Momentum ETF and momentum investing in general. But let me show you something real quick here. Going back to 2014, so we have momentum investing, we have growth investing, and value investing. So I just took 3 ETFs, the value ETF, the S&P 500, which is growth, and momentum. And clearly, momentum has been outperforming by a large degree over time since 2014. Now, these are ETFs, right? So that goes to show you the truth is that momentum works. So, if you're buying momentum, it works. But the issue with this becomes, again, as I said, when markets are trending lower, it becomes a problem. Now, interestingly enough, the problem with the momentum ETF is that it has to be invested all the time. So in theory, so for instance, we use momentum as part of our investment strategy in our portfolio. So when we're running portfolios, we do have a portion of our portfolio that is invested in momentum. But the thesis behind momentum is that when that momentum is over, you sell that position and raise cash. So if the market is losing momentum, you're increasing cash levels. Well, an ETF can't do that. So what the ETF does, again, so here's the differentiator. For instance, if you look at the momentum ETF, the holdings are different all the time. So for instance, in 2020, as an example, Tesla, Apple, Microsoft, Amazon, NVIDIA, those were the top holdings in 2020. Brent, slide over to the very last one, 2021. But in September 2021, it's now Tesla, JP Morgan, Berkshire Hathaway, Walt Disney, Bank of America. Now, the momentum ETF switched positions, right? But it didn't raise any cash. It just changed positions about what it's owning in the ETF. Now, here's the important part of that. Brent, we can come off of that for a second. The S&P 500 doesn't do that. If you just buy the S&P 500 index, the top 10 holdings are all market cap weighted. So the only thing that changes in the market cap weighted ETF is just what changes in the market cap. So NVIDIA might be number 1 or number 4, but it's still going to be in the top 10 during the whole time because of market cap. That doesn't change that much. But let's look at some specific moments in time. And here's the problem with momentum as a buy and hold strategy. Now, again, if you're using momentum and you're buying individual equities, when that momentum is over, you sell the equity, right? So that's the whole thesis behind momentum. This stock, as I showed you in the ETF, Tesla and Microsoft and Apple were number 1, 2, and 3, and then it changed, and it was JP Morgan, Berkshire Hathaway. So financials had gotten momentum, and technology had lost momentum, and so there was a change in the ETF, and so you would have sold those other positions, right? Raised cash, and then you would have bought other things. Well, the ETF doesn't do that. Let me show you where the problem comes to this. Here's those same 3 ETFs, value, momentum, and growth, in 2015, 2016. Momentum got crushed during that sell-off in 2016 because, again, it's holding stocks that are failing momentum at that time, right? So the markets are going down, and it's going down faster than the overall market. Let's take a look at another period here. This is 2018. So this is the Fed taper tantrum, right? So again, momentum's outperforming in the first half of the year, as you would kind of expect, right? And then it actually has a much bigger decline on a percentage basis than value and growth during that sell-off at the end of the year. Because again, momentum works on the way up as it does on the way down. We can also look at, for instance, 2020. So this is the March debacle, right? So we have the pandemic shutdown. And again, owning momentum during that decline didn't really work for you. Now, coming out of that decline, momentum was great, right? Because everybody was chasing stocks. So momentum is awesome. So what's the important thing here? And again, we can see this again, just one more time, just in 2022. But what's important is, and we cover this. So if you go to simplevisor.com, as an example, and you can do a free subscription for 30 days, check it out. But go to our stock screener. We actually post momentum and relative strength stocks on the homepage of SimpleVisor, so you can kind of get every day. You kind of get what the latest kind of momentum and relative strength stocks are. But what's important to understand is that momentum as a strategy works very well. But the value that is in momentum investing is that you raise cash when a stock is losing momentum, right? So as things are changing, you're selling that stock to buy something else that is getting momentum. And holding an ETF, during periods where the markets are declining, can be very painful. So that's because, again, the ETF can't raise cash. It's always got to be invested. So there is a difference between buying a momentum ETF versus investing in momentum stocks. And those two strategies are very different. But it's important to understand to buy the right strategy. And go back to that chart real quick for me, Brent. It's important that the markets tend to track economic cycles. And so your strategies are going to change with the economic phase that you are in. So again, when you're coming out of a recession, your deep value, safety type stocks, as the market begins to recover, you're kind of moving into value and starting to lean into growth a bit. And then as the economy is really humming along, that's when your momentum. But then that's going to start to reverse as the economy begins to slow, begin to struggle. You're going to move into kind of your value, income oriented, then contrarian value, and then back to deep value when you're actually in the recession. So just understand that your investing strategy needs to be flexible, And because momentum investing works great on the way up, but remember, momentum also works on the way down. So if you're trying to buy momentum in a market where momentum is failing, it's going to hurt you a lot more. So again, just, like I said, I kind of went through the whole analysis on the article today. It's on the website now at realinvestmentadvice.com. But it's an interesting question because I get it a good bit. And, kind of the one of the things that we're looking at very closely, and particularly as we start to move into a slower economic environment, value has been really underperforming momentum here for a while. And, we're kind of getting to the point of where on a relative basis, value should start to outperform growth and momentum at some point. Maybe we're seeing that now with some of the defensive rotation. I think it's too early for that at the moment. I think that whole defensive chase we've seen this summer has been more about Fed rate cuts versus slower economic growth. But I do think that at some point we're going to see a return to value, down the road. And so again, but that will likely equate with a much slower economic environment. More trouble with employment, et cetera, and we'll see what happens. But again, if the market becomes more defensive, value should really start to play, and particularly value dividend should play a lot better. We'll see what happens. But again, that article on the website this morning, if you've got any questions kind of about value. But again, the concluding point is that, there is a big difference between buying an ETF and holding it versus investment strategies around value, momentum, growth, et cetera, that raise cash, et cetera. John, good morning.
Yeah, good morning. So in ETFs, exchange traded funds, Lance, they could work very well, but to your point, they are passive strategies. So we or you have to be the one to employ that active approach, right? You've got to step in there and take profits, raise some cash and to rebalance. Because you're right, you look at a year like 2022, momentum was, if you would have held that ETF, you were down just as much as what the Standard & Poor's 500 index was, about 18.25%. Yep. But, value that year, value did, like more of a value-based ETF, did pull back that year. But you look at the ETF and like in your blog this morning, the IVE, it was down a little over 5% in 2022. It weathered that market volatility a lot better than what that momentum ETF did. But it wouldn't have done you any good if you wouldn't have stepped in and made that decision or to kind of reposition or rebalance your portfolio, right? And
again, look, and like we run an ETF model. Yeah. We have a model that's all ETFs, but we're actively managing that. So it's interesting because we have these ETFs and it's like, oh, those are passive indexes. Yeah, the index is passive because it just kind of holds the stocks, but investors can actively manage a passive index portfolio and, rotate your strategies as the market changes. Because again, what works today won't work in 6 months from now. But look, nobody wanted utilities and real estate last year, right? Everybody hated it. It was the most hated sectors, and now people can't get enough of them. So things change, and we have to make sure we change in our portfolio. And we'll come back, and there's a couple of good questions in the chat talking about some of these things in particular. So we'll come back and answer some of those questions. And John has some topics to get into as well this morning. So don't go away. More of the Real Investment Show coming up. Hey, hit the like button. Like.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Oh, Red, I declare, I plumb missed that candy coffee. Whatever am I gonna do?
Don't you worry, little darling. We'll watch it again on our YouTube channel.
Why, Red, I never.
The Real Investment Show YouTube channel has all of our past presentations, from Candid Coffee and Lunch and Learn to special topic discussions, and all of our live show recordings preserved for you. Subscribe now to the Real Investment Show YouTube channel, or look for the link on our website at realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Today is a very sad day because we had a very serious set of deaths in our house.
The Real Investment Show podcast.
It's been just a very traumatic few days. We lost our new coffee maker, we lost our air fryer, and we lost our oven when this power surge came through the house.
Same show, your schedule.
That's how big the surge was coming through the house, but I've not had coffee for 2 days, so just beware. I don't know what you're going to get this morning on the show, but
at realinvestmentadvice.com.
I'm a little cranky.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning. At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Good morning, welcome back. So I want to answer a couple of questions that are running around in chat this morning. Brian asked this morning that about our recent purchases of an ETF. So speaking of ETFs, REM, which is a mortgage REIT ETF. And also we made a purchase of Annaly Capital Management in our equity model. The reason for that, and these are small starter positions right now, and we'll build into them over time, is that mortgage REITs respond to falling interest rates and particularly Fed rate cuts because a mortgage bond is based upon the repayment structure of the bond. And there's what's called a prepayment speed to these bonds. So in other words, you think about your mortgage, right? So you are going to buy a house, you go get a 30-year mortgage on your house. Now, the average time that people live in a house is about 7 years. Unless you're me, it's 2 years. But
give you 2.5.
Maybe 2.5. But for most people, the average time of living in a home is 7 years, but the mortgage is 30, right? And so people sell their house for whatever reason, and then they go get a new mortgage. And so what a mortgage pool owns is they own real mortgages. So if you own like a Ginnie Mae bond, Government National Mortgage Association bond, which is government guaranteed. It's just like a Treasury bond. It's government guaranteed, but it owns mortgages, a pool of mortgages, Fannie Mae, Freddie Mac bonds, et cetera, same way. These are just a pool of bonds. And so as somebody pays off that bond, the principal is returned to the owner of the bond, right? And this is one of the problems with if you own a mortgage-backed security in your portfolio, and which are great investments, by the way, but we don't use them in our portfolios here because clients can't understand them and they don't understand how they work. And no matter how much explaining we try to do, they just can't get their head around why they continually lose money in the bond every month. and they're not, and so it shows up red on their portfolio. It's like, well, I paid $1,000 for this bond. Now it's $950. Now it's $900. Now it's $875. Now it's $850. Why is this bond just going down? Mortgage bonds go to zero because you're being paid back principal and interest, just like a bank, right, would be collecting principal and interest on the mortgage every month. That principal is getting paid down. And the speed at which that principal gets paid down is based upon interest rates. So as interest rates decline, people, refinance their mortgage. And so we had a lot of people run out, not a lot, but we had a few people run out and take out 7% mortgages. Well, those are now in those pools. So as interest rates come down, people are going to go, oh, I now get a 5.5% mortgage rate. Mortgage rates yesterday were around 6%. So say in a couple, the Fed cuts rates, and by the end of this year, let's say mortgage rates are 5.5%. Now people that have these 6 and 7 and 7.5% mortgages from the last couple of years, they're going to go out and refinance that mortgage. So that's going to make a payment, right? That mortgage gets paid off and a new mortgage is put in. So the people that own that mortgage-backed security that has that structure is going to collect that principal and interest payment. So again, there's a lot that go into mortgage-backed securities, and they are complicated. And there's a lot of things to understand about them, and they can be a great tool in your portfolio, but they can also be a little bit of a tax nightmare. So again, if you really don't understand mortgage-backed securities, and then this is the reason we don't use them with our clients, is because it just causes more headaches than really it's worth. I mean, we can achieve the same outcome in different manners, but companies like Annaly Mortgage and Agency, the Agency, which is another mortgage REIT, and REM, which is an ETF of mortgage REITs, these are companies that are basically servicing, collecting, and managing these mortgages, and so they tend to perform better as interest rates are coming down. So as the Fed starts cutting rates, we should see companies like Annaly begin to perform better. And plus, you're sitting around, collecting a 13% yield right now, while you're kind of waiting for the action to come. But that's the bet. I mean, now we could be entirely wrong. We'll see what happens. But if we do get into a spate of refi activity, that could bode well for those positions in the portfolio. So great question. Another one was, is it okay to buy TLT on this Friday after the Feds? Bonds are extremely overbought here. In fact, if you read our daily market commentary, which is out on the website this morning, and again, if you don't subscribe to our daily market commentary, you're really kind of missing out. We email it to you. If you go to the website, realinvestmentadvice.com, and just subscribe to the daily market commentary, we email it to you every morning. You'll get it in your email box 7:30, and we do a brief market review, just a couple of topics, takes like 3 minutes to read. It's a really short read, but we give you a market trading update every day. And today's comment is on Treasury bonds. It's just, they're very extended. They're very overbought. There's a potential risk that, if the Fed disappoints and only does 25 basis points tomorrow, we may see yields pop up a little bit. Kind of the buy the rumor, sell the news. I don't know what's going to happen, but something. We saw a little bit stronger economic data yesterday from the New York Fed. If we see kind of economic data strengthen here a bit, that may bring some concerns of inflationary pressure. That could lower yields, increase yields short term, bring down bond prices. Something needs to happen. Nothing goes straight up and nothing goes straight down. Something's going to happen that'll bring bond prices down a bit and give you a better entry point. So I'd be a little bit patient. And if you're just starting a position, you're going to buy 5% of your portfolio on Treasury and TLT, buy 1%. And then if it comes down, buy, 2%. And then if it goes back up, buy another 2%, right? And work your way into it. Just be a little bit careful, going whole hog right here, as they say in Texas, whole hog. That's a Texas thing. But yeah, just be careful of that right here, because again, just like a stock or anything else, just extremely overbought.
Whole hog. I know exactly what you mean by that too.
Yep.
It is language around here.
It is language
in these parts, right?
Yeah.
So you're talking about TLT. Go ahead.
Yeah. Again, if you're going somewhere, it's just down the road a piece.
Yeah.
Yeah.
That way.
Yeah.
So you're talking about TLT, long-term bonds. So I'm getting a lot of questions around even the short end of the yield curve, because so many folks they've been kind of sitting in cash, enjoying the 5% yield, and now they're realizing that, hey, there's going to be a decision this week. Fed's either going to lower 25 basis points, maybe 50 basis points. if they start lowering rates, hey, how quickly will that money market yield start to come down? And should they start, maybe branching out a little bit further? Should they go out, a year or two, maybe 3 years on short-term bonds? Start kind of extending that out a little bit to start locking in some yields. Mm-hmm. So their question is, should I do that now or should I wait until after the Fed decision? Any thoughts?
Well, it's kind of a 6 and 1/2 dozen the other, right? Because, great, I can, let me put it this way.
Yeah.
If you're going to buy a bond and you're going to hold it till maturity, right, and you want to try to lock in the yield before the Fed cut, then, yeah, just buy the bond, put it in your portfolio, forget about it, collect the yield.
Mm-hmm.
But it's all relative, right? Because we're talking about yield, right? And so now, and really what we're talking about is coupon. If you're trying to lock in a coupon, you want to lock that in now because new issuances will be issued out at a lower coupon. And the coupon is what you're going to get by holding it till maturity. The yield is relative. It's just a function of price versus coupon. So, if the Fed cuts rates tomorrow, yields are going to come down with that. But understand that, you're going to see potentially at some point that's going to pop back up and your bond price is going to come down. So again, when you look at your portfolio and you see red, don't freak out because, you bought it for the yield. But again, all you're getting is on that type of a structure, all you're getting is the coupon, right? So if it pays 5%, you're going to get 5% to maturity, and that's all you're going to get, no more, no less.
Yeah, and so when you were talking about those mortgage-backed bonds a little bit earlier, and you're talking about, the various custodians out there and looking at their gain-loss page, and you see, so if you own that mortgage bond, to Lance's point, you start seeing the value come down, like you see right on your screen. I can't tell you how many conversations I have with folks that own mortgage bonds, and they're like, John, I'm losing all this money. I'm like, no, you're really not. It's not a position anymore. It's now the principal and interest that you're getting is over here in your money market. It's been shifted over here. Same thing with owning individual bonds. When you buy a bond, to Lance's point, depending upon what interest rates do, the price of that bond will fluctuate. You will see red or green on your screen, depending on how that bond's price reacts to moves in interest rates. So if you buy the bond and you're holding it for the yield, and you have every intention of holding that bond until it matures, let's say if rates tick up here a little bit and you see some red on your screen, don't panic. You haven't, quote unquote, lost money on the bond. You would only lose money if you decided to sell that bond before it matured at a time where interest rates were rising, and then you would actually lock in the loss on your principal at that time.
Exactly.
Right?
Exactly. One other question here before we get to the break is, will the dollar get the dollar's been dropping lately? And Brent, can you bring this chart up for me? The dollar's been dropping lately. Is that expected to continue? No. Actually, the dollar historically drops going into the first Fed rate cut and then strengthens coming out of the rate cut. So, again, if you're trying to buy UUP as an example, UUP is sitting right on pretty important support here. And historically, again, recession, non-recession, the dollar, the dollar is a reflection of economic strength. And so if you're cutting, interest rates potentially, and you don't have a recession, that tends to bode really, really well for the dollar. But even, with the first Fed rate cut, you typically attract flows into markets, at least in the near term, even if there's a recession on the horizon. But again, though, the dollar, you should kind of expect, again, look, and let me just remind you, these are averages. Doesn't mean it happens this time. This time could be different. It doesn't always work out that way, but that's the problem with averages. But historically, on average, the dollar is very oversold right now. You're sitting on pretty important support. And, any type of good news that attracts flows from other currencies into the U.S. dollar will be supportive of that. So you would expect the dollar should rally post the Fed rate cut on average. And yes, whole hog is only a Texas term. Texans invented it. We own it. We copyrighted it. Other people may steal it, but it's a Texas term.
It's in the Texas dictionary.
Exactly. People. Be right back after the break. I'm just joking, by the way.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
I want to put to bed. Can we just put to bed a myth right now? I've seen this around and Pete, I'm calling you out here. Talking about the dollar. We keep printing money and the value of the dollar is declining. Okay, stop it, right? Here's a chart of the dollar. This is the dollar index going back to 2008. Now, is the value of the dollar increasing or decreasing? I will leave this to you to determine. Yes, we are printing a lot of debt. Yes, we are. We are running a big deficit. Yes, we are. Are there problems with that? Yes, there is. The value of the dollar is increasing, not declining. And yes, it goes up, it goes down, it goes up, it goes down. Why? Because it's relative to other world currencies, right? But overall, since the financial crisis, the dollar has been increasing. And it ebbs and flows over time. There are periods where if we go back to 2003 through 2007, the dollar was declining pretty sharply, right? Because we were going through getting ready. The economy was not growing that strongly, and we were heading into the financial crisis, et cetera. So yeah, the dollar is going to underperform at that point because why would I want to store my reserves in the U.S. dollar at that point if there's problems economically? But you may not like the U.S. Pete, you may not like the U.S. And yes, we have debts and deficits, but we're still the cleanest shirt in the dirty laundry at the moment, right? And again, that could certainly change. But everybody's running around going, oh, the value of the dollar is declining. Okay, yes, the relative purchasing power of the dollar has been declining since 1900, right? Because inflation goes up every year. So a dollar, if you took a dollar and you stuck it in a can and buried it in the backyard in 1900, yeah, that's going to buy you a lot less today than it did in 1900 because in 1900, inflation was just starting out, really. I mean, we were back in 1900, but since then, yes, inflation increases every year. So as the cost of goods or services go up every year, and look, we're going to have 2% inflation, a dollar is not going to buy you what it bought you last year because it'll buy you 2% less because you've got 2% inflation. But the value of the dollar is not declining. So I know, and that's put out in a lot of videos. to scaremonger people.
Well, I want you to buy my gold for me.
That
just buy gold.
Well,
for me,
fear sells. I get it. I need the commission. But fear sells. I get it. But just, look, we got to keep things in perspective about what's going on. And so anyway, so that's the dollar myth put away. Let's move on.
There's a client that I work with, and he's a farmer. We were talking about hogs, and he made the comment. He's like, John, I know, the whole world's got issues going on. The U.S. government, we have issues going on. But he said right now, the U.S. is the cleanest pig in the pen. He raises livestock. So he's like, we are the cleanest pig in the pen. I'm like, man, I'm going to use that. In fact, I just did. But if you there it is, right? So if you look at this on a global standpoint, though, if there is really global volatility, global uncertainty, not just the U.S., but where are other countries going to place their currency where in a market environment that's stable, where they know they can get their currency in return? It's going to be treasuries. It's going to be dollar denominated, right, Lance?
Well, yes, and again, but this always brings up a whole boatload of other myths that kind of come along with this, and of course, immediately, somebody and already in the chat, I didn't have time to actually pull up a chart of it, and it didn't take long, but look. Yes, gold as a function, right? If I buy a gold coin, right? Gold coins have a numismatic value to them. They're collectibles. And so, yes, they retain value over time. And yeah, there's nothing wrong with buying gold. We've talked about this, previously. I'm not ready with that chart yet. It's got issues. I've got to hold on. Brent wants to put a chart up, and I'm not quite there just yet because I don't have enough data. One moment.
Even Lieutenant Dan, he's talking about, oh no, that wasn't Lieutenant.
Yeah.
Talking about whole hog in England.
Yeah,
it is Lieutenant Dan.
Yeah,
Got
that is Lieutenant Dan. Brent, never mind the chart. I can't get it. I'll put it together somewhere. But look, the bottom line is that there's a lot of ways to combat increasing inflation over time. Yes, you can buy gold, and gold will buy you the same relative value that it bought you in 1900. In fact, Peter Schiff did this analysis. He said, well, if I own gold, I could buy, a shirt in 1900, and I could buy that same tailored shirt today. And that's a true statement, right? So gold held that relative value over time, and that's an important point. But there's other assets that will do that as well. The stock, if I invested the same dollar, if I took $1, invested, or let me use Peter Schiff's example, and I did this analysis on our website, by the way, as usual. But let's see if I can find that chart for you real quick while we're doing this. Yeah, so we wrote an article called "Conviction or How to Lose a Lot of Money in Investing." And this goes to the heart of really what we're talking about, because there's a lot of people that are very convicted about the idea of kind of addressing Pete's point, is that, we have all this debt, and this is going to kind of be the end of times for the economy, et cetera. So Peter Schiff did this analysis trying to prove his point about gold. He says, well, if I bought a suit in 1900 and I could buy that same suit today if I bought it in gold, right? So if I held that gold in that $41.42 in gold that I could have bought a suit in 1900, I could buy that same suit today. If I invested in S&P 500, I could have bought 20 suits in that same time. You can bring up the chart, Brent. This is a logarithmic chart, but you can see the value of gold. That $41.42 turned into $3,650 in value going back from 1900, but I had 30,000, almost 31,000 if I just invested in the stock market. Now, there's times that gold performed very, very well. Gold's performing very well right now, by the way. And there's nothing wrong with, absolutely nothing wrong with owning gold, right? And yes, there are multiple ways to offset and hedge inflation. And but again, what people like Peter Schiff do is they come up with these scare tactics. And it's like, the dollar's losing its purchasing value, so you better own gold. And he happens to sell gold, right? So, or he's talking his book in particular. We have a portfolio that owns gold in it. We've got portfolios that own stocks in it. It depends on kind of what your risk tolerances are and those type of things. So that's all personal, how you invest it and approach it. But just don't get wrapped up, in this idea of, the dollar's going to zero because we have all this debt and we're running a deficit. Yes, those are problematic for economic growth. They do have problems, and I'm not, sidestepping that at all. But those are very, very long-term issues. Very long-term. Those are 20, 30, 40, 50-year issues that are going to play out over a very long period of time. And historically, there are plenty of asset classes outside of just owning gold that have actually performed better for you over time. And remember, at the end of the day, our job is to try to provide the best performance for our money over time, right? So the whole point, and the point of that article, and I encourage you to go to the website and read it. It's called Conviction, or How to Lose a Lot of Money Investing, is precisely on that point. Just Google, if you just go to the realinvestmentadvice.com webpage, type conviction in the little search bar right at the top, says right next to client portal, it'll bring that article up for you, and you can read it at your leisure.
Yeah, I mean, so this narrative it's still out there, Lance. Just last week, I was in a conversation with an individual who, I got the phone call and they asked me about, hey, John, what do you think about, I want to put 100% of my portfolio in gold because I know next year in 2025 the dollar's going away, and hey, I need to do this now. Mm-hmm. And I said, okay, let's just take a step back here and think about this, right? Hey, if you want to own some gold, just like Lance mentioned, there's a portfolio strategy that we have that has a small piece of gold in it. If you want to have some gold as part of your overall portfolio, or part of your overall strategy as a holding, as a diversifier, great. But it doesn't have to be an all or none decision. So, fortunately, we were able to kind of talk that through, and I was able to at least maybe kind of calm some nerves to say, let's just kind of think about what you want to do here, especially with all the strength that gold has had as of late. Is right now the time when you would want to put 100% of your money in that asset class right now, mm-hmm. right? So we got to step back from the narrative. We got to get away from the hype, because there's so many scare tactics out there that are going to lead you to making a knee-jerk reaction, which probably isn't the best decision to do at the time. Right.
And as one of the people in our chat commented, that's okay, because Shiba Inu cryptocurrency is back. It's now at 0.0000133. So I mean, you can buy a lot of that.
So just yesterday had this question too, was, hey, John, I know interest rates are going down. I'm trying to find a way where I can, maybe pick up some extra growth or some yield. I'm a conservative investor, exact words. I'm a conservative investor, but hey, what do you think about me investing in some cryptocurrency? And I went, did you just hear yourself there? Maybe not the best way to approach this, right?
Yeah, and again, look, we're not poo-pooing any asset class.
Sure.
And Jack made a really great point. He says it's not about what you buy, it's about when you buy it. And that is the best statement out there, which is absolutely correct. You buy it at the right time, it's great. Any asset is. I mean, you can buy, look, NVIDIA's up 900% since October of 2022. It's beat everything, right? So it's about when you buy things. It's also, remember, importantly, it's about when you sell them. Because if you don't sell them, you don't make any money. So you got to do both sides of the equation. All right, wraps up the show for today. Be sure and like the channel. We do appreciate it very much. And it does help us with Google if you will click that like button. Again, we got a bunch of people in here watching, and we need more likes. So everybody should give us a like, and we appreciate it very much. Get by the website. Everything's out. Daily market commentary is up already for you, so it's all there on the website now, realinvestmentadvice.com. I'll see you back here tomorrow with Danny Ratliff.